One of the debates that is ongoing in the investment community and really elsewhere in 2018 is passive versus active management. And in many camps, it seems that passive is winning as the popular choice. So what does that mean for investors and for how they manage their rights and also how they manage their responsibilities? And as the title of this next session asks, is passive investing compatible with active ownership? To introduce our panel this afternoon, if I can ask you to take your seats as I introduce you, Martin Lawrence, Director and Co-founder of Ownership Matters. He was formerly Head of Governance Research at ISS Australia New Zealand, and prior to that he was Manager Corporate Governance at the BT Governance Advisory Service, now Regnan. Susan Durich, who is Head of Global Equity Beta Solutions Asia Pacific ex-Japan for State Street Global Advisors. She has responsibility for over 120 portfolios, 7 portfolio managers across the region, and about $140 billion in assets. And Christian Fock, Chief Investment Officer, CBOS Super. Christian has over 26 years industry experience. He's also a management committee member at the Investor Group on Climate Change and an advisory committee member at PRI Infrastructure. And your moderator for this afternoon's session, Ed John, Executive Manager Governance, Engagement and Policy at ACSI. You probably all know Ed. He's got over 10 years experience advising ACSI members, and he also has a 10-week-old baby. So the fact that he is here is really to be applauded. Please welcome our panel.
Thanks for that, Ali, and thanks for announcing. I think that gives me a handicap or some sort of sympathy vote already. Now, I wanted to start today's discussion by really going back to where we started today, and that was with the words of Justice Neville Owen in the HIH Royal Commission. And I think that quote, again, which was used and is still so prominent today, the idea that if shareholders as owners are either unwilling or unable to exercise their powers or make themselves heard, then directors and management will lack guidance and they'll lack constraint from those whose interests they're there to serve. And again, that quote was 15 years ago in the HIH Royal Commission, and if we think about the mega trends in the industry, the rise of super, the rise of passive investing since then, I think they're really important topics today. And it also, where we started today's discussion with that fact that ACSI members today own on average 10% of every ASX 200 company. If we also think of the passive global funds, they probably account for another 10 or 15% of every one of those companies. So I really want to have that theme that we're in this together when it comes to active ownership and the issues we're discussing today. And if we think about where those issues are done right, there are so many opportunities for collaboration to deal with the sorts of topics we've been discussing today. But also, whether done poorly, I think they can certainly sort of prop up or give support to some of those companies where we're trying to affect change. So the way we tackle those issues is critical. And I think we really have a shared responsibility to get it right on these issues. So with that backdrop, I'll start the Q&A. And to begin at the top, really, and I'll ask Susan first, what do you see as active ownership and how do you behave like an active owner?
Yeah, well, if you think about our funds under management, we sort of regard ourselves as almost a permanent holder in companies because of the index nature of our business. But active ownership to us is using our voice and our vote to influence companies on long-term governance and sustainability issues, but also to protect and promote the long-term economic value of our clients' investments. And in behaving as an active owner, we've designed an asset stewardship program to have an impact. We use a risk-based approach to identify thematic and company issues that are important to our clients. And we proactively identify companies for engagement in order to mitigate the ESG risks in our portfolios. And you'd probably be surprised to know that 85% of our engagements we consider to be active. And that's where SSGA has sought the direct dialogue with the board and with the management of the companies that we have identified in that screening process I mentioned. Just to go on about maximising our impact, we publish thought leadership on topical issues. We want to inform companies and also educate market participants with those. And this often puts us at the forefront of issues, and most recently for us it's been board tenure, climate change, and not to be forgotten, and hopefully you have seen it, diversity emphasised through the Fearless Girl campaign. We do measure whether we have impact, and this is not, though, through the numbers game of how many staff we have or how many engagements we've done per annum. Success for us is where a company actually implements the changes to their ESG-related programs that we had been engaging with them on, or where there's other market participants, such as asset owners, asset managers, regulators, proxy advisory firms, that are influenced by our thought pieces and actually join the party.
I mean, Christian, for you at CBUS?
So we are small enough that we have both active and indexed type portfolios, but we recognise that as funds grow, and I know also for many larger funds, the capacity to use active management is much harder, and so you're forced to think about buying the market. So if you're buying the market, I think there's a couple of consequences. First of all, by nature, you become a longer term investor. You're not trading. And secondly, effectively, one of the levers that you can apply to increase your value is actually your influence through your ownership and using the fact that you are a long-term owner to start to raise issues that are beyond the metrics that drive short-term and sometimes not necessarily value accretive activities. The flip side, though, is how most asset owners are resource constrained. So you have to start to make choices on where you spend your time. And I think it's fair to say that both the resourcing is increasing, which is positive and necessary if you think about how your influence can actually affect value. But secondly, I think that the asset owners are beginning to learn a little bit more around, well, what issues make sense to sort of come behind and focus your efforts. And so examples like, I think it's like the Climate 100 initiatives, where you're actually getting asset owners coordinated globally with a consistent approach, are really interesting trends.
We'll certainly pick up on those. I mean, Martin, again, as an advisor, the sort of perceptions of what active ownership looks like?
I'd tie it back, and I should stress I'm an observer of active ownership rather than an actual active owner. I'd stress it is making sure that the management of the companies in which you're invested know what your views are and can be in no doubt about them. Sometimes that means voting against them. Sometimes that means communicating them very forcefully. And I suppose in that sense, when you think about passive investors as active owners, their great strength as an active owner, which Susan alluded to earlier, which is they are permanent long-term capital, is also their great weakness, because they can't do what an exasperated active manager can eventually do, which is say, I don't trust you anymore, I'm out. And so you don't own that ultimate sanction. I'm not saying that active managers necessarily use that perfectly. I mean, history shows that no one is perfect and people have made mistakes. If you have a look at the parliamentary inquiry in the UK into the collapse of Carillion, which was released yesterday, they, having a stewardship code, actually look at the role of the major institutional investors, and they're actually quite complementary towards BlackRock, which I think was the largest holder in Carillion at one point, but in being quite complementary about the role they had engaging with Carillion about some governance issues, they did point out that ultimately their decision to exit was when Carillion share price declined very, very rapidly, and so it was removed from indices.
I mean, pick up on that theme and thinking about even the changes in index investing. I mean, perhaps Christian, that idea that everything's in the index, and I mean, is that still the view?
Well, I would actually, I think this is a positive development. I think more and more funds are looking at alternative ways of accessing the market. It doesn't have to be the traditional cap-weighted index. Now, I think that's good in a couple of senses. It means that you can tilt, still efficiently your strategy to companies, say, that exhibit a thematic that you think you want to access, whether it's more long-term in terms of the way that, or quality in terms of the way that they run their business. There's certainly products around that focus around climate exposure. None of these are perfect, so it's still sort of dependent on how people interpret the data. But the interesting thing, hopefully, is that it will encourage companies to start to provide different types of reporting. If they want to get a certain message across, then they'll support that by actually reporting things beyond just the sort of the shorter term financial metrics. And then the benefit is that as investors look to deploy money towards those thematics, the indices or the thematic type of indices that are constructed along those lines will be of higher quality than maybe what we have today.
Just to, I guess, dig slightly deeper, because I know CBUS is very active and is engaging with the boards and management of some of the companies you're investing in. I mean, do you think it changes the dialogue when they know they're in your passive portfolio, or they know you're potentially a long holder? How have you, attacked that issue?
So I think there's a couple of things, and this is a symptom of a transition generally, I think, as asset owners, partially as we resource up, but partially as our strategies change. So where we have seen evidence of more proactive engagement is either when we're launching an active strategy, so they want our capital. So that's certainly an additional lever that we have that we didn't have before. Secondly, and although we don't routinely divest, where there have been other investors that have high profile had divestment, our access, if we decide to remain and engage first, our access to the companies suddenly become available where that wasn't the case. So I think there is probably a role for that to try and bring to attention. And then the third instance, which feels a bit reactive at the moment, and I'm hoping that will become a more proactive engagement, is when you're voting for something that's not supported by the board, but we're getting close to the threshold where it might make a meaning. Then beyond that, clearly, I mean, we think that the voting's only one part. You get far more out of a more mature engagement, both a two-way conversation, and so certainly the activities that AXI facilitate, but also that we try to initiate ourselves, we believe are really important.
I just want to return to, I guess, one of those logistical challenges. I know, Susan, in your introduction, you talked about the numbers game, or that challenge. Yeah. When you do have portfolios of thousands or potentially tens of thousands of stocks, how to, again, have that active ownership overlay or action that, how you tackle those issues?
Yeah, and as I mentioned, we have a screening process, and not remembering the exact figures, but it's something like 13,000 votes a year that we as a company would have to do. And so the screening process is to choose those topics, those companies, and put priorities around what we want to focus on. So every year we've got a priority list. It usually includes a sector, it usually includes thematics, and then how topics that we're going to vote on. So gender diversity is one, and governance is another one that we're going to use our vote where we're not being heard. with our screening process, we still managed to cover around about 45% of our equity AUM with engagement. And then when we have the same sort of process over actually physically, manually looking at the company votes. And we do get around about 40% of that covered as well, to actually delve into it.
I mean, I think as Christian flagged from CBUS's perspective, but that question of resourcing, and again, it might be throw forward 5 years or 2 years or one.
Yeah.
I mean, do you think there'll be increased resourcing or increased focus?
And we have been increasing resourcing, but we also use technology, and we also use the likes of proxy researchers to help in that as well. Definitely in the future, we can see that the growth will continue because the focus is so important, and we believe that this type of asset stewardship is incredibly important.
Absolutely.
And just to think about the active management side of it, and owning all the stocks. The thing with our asset stewardship, it's not a short-term thing. It is a long-term thing. Change is going to take time. When you're near permanent holders, then you're going to be there, and we consider ourselves, or what we want is a partnership with the companies where they actually trust us and want to work with us. If you're an active manager, yes, you can divest, but then that's it, game over. You don't have that ability to work for the long-term return. And I think I said at the beginning, we're after the long-term economic value, not just the economic value over the next 3 to 6 months.
It's almost that partnership with still the challenge there, or the oversight side. I mean, Martin, again, as an advisor, again, you're looking at a lot of companies. How you sort of juggle that numbers game or observe?
Yeah, I always think, when I think of passive managers bulking out their stewardship teams, which is a fantastic development, that I know what it takes for us to cover 320, 330 meetings in a year. You'd have inklings yourself during part of your day job. That takes us 7 people working full-time. They do other things other times of the year, but that time of year it is more than full-time gig. And so if you extrapolate that out around 13,000 meetings, you end up with a couple of hundred people. Now, I'm sure Susan would love to have a couple of hundred people on the stewardship team worldwide, and I'm sure those who are in those teams for large firms would love to, but that's just not how it is. And so I guess you are forced to do what we do as well, which is triage and look for the ones that are either the biggest weighting or just from market chatter that are the most controversial. I also wanted to raise something that is a logistical challenge for all owners in Australia wanting to challenge management, but I think is particularly acute for passive owners simply because of the nature of what they do. Australia is a market where we have decided that preemptive rights have no value. You are not protected as an investor. Your interest in the company can be diluted without your consent, which is not the case in the UK or Hong Kong or Singapore. The way that you make sure your interests are not diluted is, one, you can be big and nasty and scary to boards, and especially their investment banks, because the ludicrous thing is that you pay protection money to investment banks to ensure you aren't hurt in a capital raising, which is obviously a marvellous way to organise a system. And the problem for passive funds is because of their promise to investors and because of what they do, they don't have that brokerage to splash around and ensure they're protected. And then the second part of that is that the investment banks and some more savvy management teams know that they have to buy back in. If they don't get any allocation, they have to maintain their ownership position. And so that you hear stories all the time of fund managers fearing that they will be punished for taking on management in a capital raising scenario. Passive managers, I know of one who, in a large property entity that was recapitalising itself post-GFC, as pretty much all of them were, did not get their interest in a very large placement that was part of the recapitalisation. They went to the investment bank and said, what gives? Is it because we took on management? They said it wasn't us, it was management's decision. They realised they were the aftermarket.
So management knew they would buy back
and members of management were selling.
Very interesting one. Perhaps jumping slightly to Christian, again, I know you've been doing a lot of work around long-term relationships with companies and that sort of deep assessment. I mean, what strikes you when you do start engaging more deeply with some of these companies, and particularly where there are sort of challenging views there? How has it always been a positive dialogue?
Well, it's useful to get another external perspective of the individuals and the information they think is important or not. So that helps give a bit of colour when we vote. I think certainly, I mean, we are in the process of looking at strategies that are quite dedicated to taking long-term positions and thinking about whether there are multiple things that we can do with a company beyond just being an asset owner. But the only way we're going to feel comfortable about that is if we feel that the company is well run as well. Mm-hmm. So those things become actually very integrated, which, I mean, ultimately that's really what you want. You want the person that's deciding to be investing in the company, not just looking at the financials and have someone else come in over the top and do another. You actually want to have it as a holistic and integrated discussion. So to date, there has been certainly a lot of positive interaction. I think when you go out offering money to companies, they generally are fairly receptive. So it'll be interesting to see how that actually pans out in practice.
Mm-hmm. What happens if it comes with the offer of money, but then also opinions on issues like climate or other strongly held views? Are they welcome?
So, I mean, for us, actually, and most investors, how we think about these issues change over time as well. I think it's fair to say that initially everyone was all about what your footprint is, and they weren't asking the questions about, well, what's the company's future strategy in relation to it, which might look good from an asset owner, but actually it's not really that conducive and not necessarily as aligned to long-term investing, because there are lots of examples of companies that's current business are high carbon emitting, but they're the ones that actually have the capacity to transition their business. So why would you deny them capital? It's sort of if they're aligned. I think therefore, I think the relationship always starts adversarial, partially because you've got like only a few sort of tools that you can use, which is the voting side of things, and they don't think that you're very sophisticated in trying to understand the business. Although hopefully over time we learn a bit more, and it means that we don't just use blunt instruments. I do agree that just because of the quantum of stocks, you have to still use a combination of filtering and reducing your list. But our preference is, once we've got this list, let's use fundamental insights to actually try and look at it from a forward-looking point of view, not just at a point in time. It's interesting, the role of organisations like AXI and other voting advisory services. They're really critical, because without at least some framework around how to think about a problem, you've basically got investors that are just fragmented, and when you've got fragmented views around things, nothing changes. But it's interesting, as more and more, as the proposals that are being put up become a bit more nuanced, and we sort of feel that they're not, they are constructive to a dialogue around looking at how businesses are exposed to risk and move forward.
The shareholder proposals.
Yeah, then these shareholder proposals actually start to get traction, and the immediate sort of responses we get, which is interesting, is, why are you outsourcing your responsibility? I think there's a misunderstanding around how we actually work with the proxy, or the voting advisors. I mean, we actually work with them around what are the types of issues that we think we can get around, because obviously we need buy-in. And secondly, often when issues come up, the power is when you actually tap into all your networks. So when we come up with an issue that sort of comes up with a company, we'll do our own work, we'll triangulate it with our fund managers and challenge assumptions and understand, and we work with Axie and others. So I think there is not the sort of awareness around how asset owners are starting to collaborate on these bigger things, and it's a trend that's only going to get more powerful. And frankly, you know, if companies are genuinely saying that asset owners are too short term, and we are now starting to act in a considered way around longer term issues, they should be, we hope they should be really actually engaging positively with us. But I think we're not, I think we're at still at that transition in terms of understanding.
Absolutely. I mean, and Susan, I guess on that issue of the use of advisors, I think there's always media and others around there saying proxy advisors are voting for the asset manager or the asset owner. Just how you use advisors and think about that.
So advisors we use, the proxy advisors we use in sort of three ways. You know, obviously it's the platform that we use to do the proxy voting. We also have a voting policy which is refined all the time, and the proxy advisors have that policy, and they implement the policy on votes where, you know, it's not needed for us to have oversight on. And as I mentioned before, we use them for research. You know, as we talked about 13,000 votes, then we're not going to be able to research them all. So that's where we can use them to get that done.
I guess, you know, potentially to draw on those themes, and I think for many in this room, you know, as the prominence of specific asset owners, asset managers, I think that, you know, we're in this time of transparency, you know, be it transparency to clients, to end, you know, superannuation fund members, to the media, regulators. I mean, just how you deal with active ownership, and in a way, I mean, Christian, you've been doing, like, do you feel you get your message out there on those? Because we've obviously seen more and more scrutiny out there about votes or engagement or the companies you invest in. Are you doing a good job?
I think we could do a much better job. And again, this is a function of our resourcing, but also I think some of the maturity and the thinking about issues. So our previous process was very bureaucratic and had to go through committees, and so in the end, if someone asked you what you thought on an issue, you won't have been able to sign off on it, or even have sort of thought about it. So your default position is we don't talk about it. And frankly, that's, you know, the community doesn't see that as sort of making the grade. So we're now having to be a lot more considered around, well, how do we approach situations, how are we thinking about things, and we've also had to streamline the way that we make decisions. So, and to be honest, there's power in what you say that comes out in the media. It can influence and signal to companies a direction, but with that power, there's a great responsibility to be very careful around what you say, because you're working with imperfect information as well, which is where you know, the capacity to engage and know and understand the company, you know, before these things occur will make for a better dialogue, I believe.
I mean, Martin, on the transparency side?
I'd say one area where I think everyone involved in investment, us, active managers, passive managers, asset owners could do a much better job. And it's actually an area where passive managers are ideally suited. And it's kind of a way of demonstrating your commitment to the topic is in regulatory engagement. Passive owners are long-term owners of a market. So they're there for as long as that market is in the relevant index. And so in the case of Australia, hopefully a long time. And so that means their capacity and their need to influence the regulatory environment so it's shareholder friendly is critical. Things like preemptive rights, I mean the ASX and its enforcement of the listing rules. Investors should be able to rely on the notion that ASX companies will be held to the listing rules that they signed up, but they don't. The listing rule that is enforced is the one that you have to pay your fees. And so that's an ideal way to demonstrate your commitment to this cause in a way that is actually very helpful to all investors and especially passive owners. Now, groups like Proxy already do this work, but the more people who pile in behind, because I can tell you whenever there's a regulatory inquiry into an issue of corporate governance or matters that affect investors' ownership rights, you have 100 submissions from the various groups who work on behalf of management and against shareholders, but are paid by shareholders. And you have a submission from Proxy. You probably have a submission from the Financial Services Council. You might have a submission from us, a handful of others, a couple of fund managers. And so the more groups that put their voice to that process, the better it is. And I think passive owners, that's a place where they can demonstrate and really have a genuine interest in ensuring that that is working.
That's a good point, and I'm thinking of reverse takeovers. We managed to get that buy-side asset owner view.
Yep.
Did it strongly. The investment banks, the transaction lawyers are against, but we won the day, so let's have more of that.
Well, classic one's the ASX listing rules.
Yes, yeah. I mean, Susan, from your point of view, again, how to make sure your clients and others out there sort of see or appreciate the work being done, show that it's, we're walking the walk, it's not just marketing. How tackling that challenge?
So I think that I spoke about the results, and it's just not, we've been out, we've talked to these number of people, blah, blah, blah. But it's the results. We have been talking to regulators, talking to companies about diversity for a number of years, and as we said, it's a long process, but we get to see the results, and we let our clients know that there are results. We do quarterly reports on what we've done and what we're seeing. We do annual reports showing what we see the results being. I'd like to say that in terms of the vote, you were saying that vote's just one thing, and I think we like to think that the vote is sort of what you end up having to use when you're not being listened to, and when you're not being in that relationship with the companies. And the other things that we do is we're very visible. So we have the 2008 Stewardship priorities. And this goes a little bit towards the transparency side too. So we are letting everyone know this is what we're focusing on. And this is clients and companies alike and regulators. This is what we're focusing on. This is what we'd like to see. If we don't get help in this, then we are prepared to use that last tool of voting against you.
Yep. Yeah, that's
the other thing is that, there's a number of resolutions that don't, that get proposed that actually don't go through, and those things aren't highlighted as much, but they are very effective outcomes of engagement.
And I can give a couple of examples on diversity in Australia. We wrote to all the companies that didn't have any women on their boards. I think there was around about 38. 16 of them ended up putting females on the board, so we get to see some results. But we didn't vote against necessarily all the other 16 because we had been in dialogue with them, and it wasn't appropriate for them to change the board or whatever the reason, but we know that they've got that in their long-term plan. And when you're talking about regulators, one of the things that we've been talking to regulators most recently about is one share, one vote. So, all these shares that are being issued with no voting rights, really how that should be looked at and perceived. And just from a client perspective as well, it's not just a two-way dialogue with companies and with regulators. It's our priorities actually come from talking to our clients, understanding what they want to see, what their issues are, and so really they drive what we chase.
Yeah, and that's a really strong message. I mean, there'll be clients in the room here, and I think that idea that engagement is there and it can increase should be a really good signal. I see Martin's wiggling around. He's got something to add. But before I get to Martin, there.
I wanted to ask a question.
No, I'm the traffic police here. We have questions. Microphones roving for questions in the audience. So put your hands up and get ready. We'll hear from Martin, and then we'll go straight to the audience. So hands up and questions invited.
This is partially a question to Susan and to anyone else involved in a similar organisation, in a stewardship or other role, who may be in the audience. Last year, I think it was, the big index providers basically said, no more. If you're a company with dual class stock and you're already in our indices, we won't boot you out, but no more. We're not going to let more in. The S&P 500 was kind of the showcase one. And I've often wondered whether the major passive managers, as perhaps one of the larger clients of these index businesses, may have been exerting their influence quietly in the background. The issue about exerting influence quietly is you don't necessarily want to advertise it, so tell me to shut up if...
Yeah, so, and I think that one of the things that we have to say is that the asset stewardship side and the index management side, there is a Chinese wall.
Yep.
So what the asset stewardship team goes out and talks to clients about and their objectives is not driven by the index team. So they could potentially say something completely different to what the passive team does. I think after Snap, this became such a hot topic.
Yes.
And there was the index providers put consultations out, and there's a lot of consultations out at the minute. And we can have opinions, but really it is up to the index providers to decide what they're going to do with their indices, because they're reflecting what is available in the market for investors to invest in. And there are two arguments that, well, the shares are there to invest in, just because they haven't got a vote, too bad. But then the other side is, well, fine, I might invest in it, but then I don't have a say in the long-term strategy of that company. So I think that's a really hard question to have a yes/no answer to.
And worth noting, one of the global index providers is still taking consultation on whether or not dual class is in or out. So
I think
encourage
from a couple of them.
That's right. So anyone interested, we're keen to engage on it. So questions in the audience. We've got one in the middle here.
Sorry for the delay. Zoe from Citi. Wanted to ask you guys about, there's this trend internationally towards asking for accountability when we're voting on resolutions, particularly saying, listen, how many climate resolutions were there this year? Did you vote for them or did you vote against them? That's the number I want. Tell me in the report, type of thing. Do you think that historically, I mean, those conversations, as you sort of alluded to, have historically been quite effective privately, and a lot of them have happened privately? Do you think that the way that companies and investors think about a no vote or a vote against the board is changing now that we're seeing those transparency requirements from new sets of stakeholders?
Christian, do you want to have a shot?
So I'd like to make a plug for the stewardship code that was just launched, because that is part of actually creating more accountability for us as asset owners. And the interesting thing is that often you sort of do these things on a case-by-case basis, and you don't sort of step back and have a look at what your votes look like in a total context, and it's when maybe there's a press article saying you say this but you've done that, and they seem different, that you start to go, well, actually I think we need to have another think about what we do. So I think in the same way that we are actually asking companies and our fund managers to be transparent, I think we need to be transparent as well. And that transparency, I believe, allows you to take a step back and actually think a bit more holistically around what you do. It's also, these things go to our own boards, so a lot of the things have been delegated because they can't vote everything. But these sort of statistics start to create, I think, a healthy discussion at the board levels, and actually allows us as management to sort of start to be a bit more sophisticated in the way we might want to approach issues and have the confidence. So I think it's a very positive step, even though it might be quite challenging for us as asset owners.
Susan?
I think transparency is great, and I think that the no vote is very important because companies actually don't like receiving the no vote, and they are very willing, or more willing, I should say, not necessarily always very willing, but more willing to engage as a result of those. So everything that you've said, but that as well, I think it is effective.
Martin, have you there? Okay. We'll go back to the questions, but any other questions in the audience? While we're looking, I mean, I had one of my own, and I was thinking about, all of your responses have been very high quality, but I was wondering, putting my black hat on, have we been too positive here? So I thought, and I'll put you on the spot here, Christian, but things where you think we've got it wrong in this area, or challenges that we need to overcome? Like, what aren't we tackling? Or
I think, and again, I think it's because of resourcing, but
yeah,
I think the approach of sort of being a bit too formulaic early on probably did us quite a disservice. And I think also, there's probably was a little bit of double standard in terms of us asking lots of companies, but us not being willing to be upfront around how we are doing things ourselves. So I think if companies are going to trust us, and also if our members and the community are going to trust us, we need to be a bit more transparent around how we approach these issues and how our thinking evolves. I think it's important that we're allowed to evolve our thinking over time.
yeah, Susan?
So I think a challenge can be around transparency as well. When you've given your decision to a vote without having the background of why that vote was taken, can cause reactions, and I think that not being, and there's almost a name and shame mentality, I think is a challenge, because to have that in a relationship with your company is counterproductive in making change in the long term.
And for you, Martin, I know that you've probably got things you regret in the recommendation space or engagement.
I often say to my colleagues that if you're on the fence about a recommendation, go against, because the number of against recommendations I regret is about this big, and the number of for recommendations I regret is about that big. The one thing that I would say as a industry, and given what Ownership Matters does as part of its activities, and what I've done for a long time, the thing that we do the worst is director elections. I apologise to anyone who's heard me say this before. The fundamental right you have as a shareholder in a listed company is the right to elect directors, which is why in the US they've effectively taken it away from you. That right to elect directors is what your influence on strategy, your influence over who gets picked. And it's a right that has largely just been ignored by investors. And I'll put us front and centre in that. We don't recommend against enough directors who we know are not very good from meeting with them for years and years and years. We're trying to get better at it and be more aggressive, and I've noticed investors be more aggressive. This seems funny in retrospect, but I was talking to a fund manager who wanted to vote against directors at AMP, but was worried about the directors being voted off. And I said, look, it's never happened. It'll never happen. Unless you fall afoul of a strategic shareholder, you can't get voted off a big company board. And I was wrong. So maybe we have entered that strange new world, although I've never seen an AGM take place in circumstances quite like it.
Question here at the front. This might be our last one, I think.
Can I ask 2 questions?
Always, Jay.
So the first one is, I mean, I think companies are obviously increasingly aware of how investors are voting, and then investors are voting themselves, you know, using insights from proxy advisors, fund managers and the like. I can tell this because of the amount of companies that now come to us directly to engage. And I just wanted to sort of get views of the panel on, I think it's an issue for the industry about how much time both, you know, institutional investors but also company management are going to be dedicating potentially to this area as, you know, individual institutional investors become more active and have a voice. And my follow-up question, if it's okay to ask too, is a little bit carrying over from this morning around the complexity of REM structures and REM reports, and just any views that you might have on the panel as to who's responsible for or who has influence over changing some of that, the sort of guidance around that.
Yep, two really good questions. Who wants to go first? Yeah, go.
My personal view on that wave of incoming engagement by company management, if they are spending that much time and your money, because they're already spending money to work out how you're voting. There's an obscure piece of the Corporations Act that allows them to work out how you're voting prior to you voting. On a non-binding REM report to avoid embarrassment, my personal reaction would be to tell them to get out of it. Like, seriously, it's a waste of company resources. On the second point about who has responsibility for it, everybody does. The first thing I'd say, and I would say this, wouldn't I, because I do this for a living, I don't think it's as complicated as people like to make out. It is often not explained very well. And it is often, I think, deliberately overcomplicated. I'm reminded of a great quote that a former CEO of Wesfarmers gave to someone I know who was trying to understand Wesfarmers' old remuneration scheme. This is 15 years ago, so it's very complicated. Who could possibly understand that? And their response was, you're not meant to understand it. Now that's changed a bit, and voting against it has changed it a bit, but it is something that I think everyone bears some responsibility for, because they're trying to cater to everyone's pet theory.
So I would say on the first, I'm sure it is a bit of a challenge, but from a large asset manager, as I said, we don't go and talk to everyone. So for us, it's almost the companies that have the issues, that the ones that we're going to be knocking on their door and ask for engagement. And the best way to overcome that is to sort your issues out. So I'll just say that. In terms of REM, I wasn't here for the session this morning, so I'm not sure exactly. I can guess what it was about, but I think that we definitely have a responsibility in asking for that clarification. You know, one of the things that we're not so happy about, particularly in the Australian market, is that the incentives are very short-term and don't really match up to the long-term strategy. So please explain that to me.
On the approaches, I think the higher value ones are the ones that are done not in reaction to a vote or leading into it. So I would prioritise my effort there. When I get people when you've already voted or indicated you're voting against something that they don't want to hear, I think it's not really constructive. So that's probably a good way to filter it. And in terms of the REM, I think I do like the changes that shareholders have had to vote down the REM report to send a really strong signal. So I think that has certainly been an important factor. And I think there's a sensibility test. So if something fundamentally wrong has happened with a company that hasn't been encapsulated, either a reputational thing that's occurred or something that's pretty fundamental, you are relying on the board to use their discretion, and I think that needs to be demonstrated too.
That's a really good point. That sort of winds up the time for our panel, but I think, again, to reflect on the themes that, this issue of collaboration of active ownership, increased transparency internally and externally, big opportunities right through. And that idea that super funds today, or AXI members are 10%, we've got another 10% in passive funds, that we are all in this together. So thanks to all the panel for shedding light on the issues, and keen to tackle the challenges together. So thanks.